Let's now connect with Krishna Kumar. He's ready to talk about his view on the market, sectors where he's investing, where exactly global investors feel that right now there is scope for outperformance and underperformance, and generally what are the concerns and the opportunities in this kind of an environment which a money manager and our viewers should be focusing on. Krishna, good morning. Thank you for joining us. How are things at your end? Hope everything is fine with your colleagues and with your family.
Yeah, all good. Thank you, Nikunj, and good morning to all. And glad that you had me here. But all well so far. Not complaining too much. It's a difficult time, and environment is challenging. So we continue to grapple with it. But we'll live to fight another day.
Well, that should be the spirit, and I think that's what all of us will have to do in these challenging times. What do you make of this sudden emergence in volatility? Just when things were coasting along very nicely, markets are revisiting things like valuations, technicals, momentum, dollar index, US presidential outcome. The volatility surely has emerged, and it has emerged in a rather cruel manner.
Yeah, I mean, we are living in a very different world. I mean, the way the world got stalled, and it's been stalled for about 6 months, it's a kind of a rude shock to the economy. And none of us were prepared for this. And to top it, there is a pandemic and there are issues which are around it. See, most economies are trying to grapple and find out ways to get out of it. And so there is a lot of fiscal profligacy. And that brings in a lot of other variables which we are not aware of, and we are seeing it for the first time. So volatility is a key function of uncertainty. And in these times when the markets are shut the economies are shut for about 6 months, you have no support in terms of falling back on numbers. So we try and normalize numbers out to number FY22, FY23. And that, you kind of see through the aberration of the year that we are going through. So the idea is to kind of wade through this, muddle through this, but you have to think about normalized out into the next couple of years, because the number of variables that you're grappling with is just unbelievably large.
The market can be divided into two pockets. A pocket which is led by Reliance has got IT and pharma in it, which is outperforming, and a pocket which has got value and banks in it, which is underperforming. Is it important to clutter the noise and look at beaten down names, or markets are telling you that stay with the leaders because that's where the disruption and rate of change in earnings growth is going to come?
It's an interesting thought. So we've been struggling with that as well, but we kind of tend to be a little contrarian, which I think you're reasonably aware of. And we try and sit in places where people are not normally there, and there is a waiting time, there is a runway to kind of take off, but whatever it is. So the fact that earnings growth is a little away and possibly a little elusive for the next couple of quarters at least, maybe 3, maybe 4, be that as it may, what you got to think about is there are pockets which are getting completely smashed, like we did for IT and pharma when it was completely bombed out about a year back. It's all come back pretty strong. I'm not very sure whether I want to buy earnings growth at this point in time, but I really want to be in pockets where there is a serious mismatch or a sharp divergence in terms of valuation compared to history. And so when I'm saying that, see, commodities and materials are pretty shunned words. And obviously the fiscal condition, the globe is not suggesting that there is going to be a massive Capex stroke recovery from priming, if you may. But we kind of are looking at that space thinking that that's the space that is nobody wants to talk about, the analysts are ignored, and the valuations are deep in the trough. Having said that, IT is one name where we think that there is a change in the world equations which will result in IT sustaining for a little while longer. Having said that, I will believe that the new IT paradigm will be different from the past IT paradigm. And hence, there will be changes in the equation. But I think Indian IT services is obviously a very promising piece. But in the equation, I think we are clearly avoiding expensive momentum, high growth forecasts for reasons that they are very, very prone, and the margin of safety is negligible given the uncertain world that we're living for.
Indian banks or even private banks are smashed, but some would argue that Indian banks are still very expensive if you look at global banks, and the entire crack in banks is more like a global phenomenon, from the JP Morgans to the Citibanks to the HSBCs. If everything globally is falling, are Indian banks simply following a global phenomenon?
Indian banks have their own doing. Indian banks are actually kind of terribly expensive for a variety of reasons. Partly the ownership is kind of as an issue. But having said that, think about the Indian banks as a structure, as a piece of thing that you will need to value by itself. In the last 4 years, you have about 30 to 40% of the corporate loan book which has gone bad. You've got about another 25% of the book, which is retail, which has been holding up and has been driving all. The MSME piece, which is about 15%, is the one which is probably going to get smashed now. And people are already pricing that there is a bit of a bump there. Put pieces together, retail is not sustainable after growing 5 years at the rate of close to around 20%. The second part is there is no Capex, so there's no recovery. So you have got no credit growth. And there is a vulnerable set of pieces, both MSME and retail, which is waiting to happen. So the expensive bits will get corrected. And there is no reason to believe that the retail and MSME space is going to, look smart for very long. Put that in context, that the Indian banks will see a massive churn. I mean, credit costs will remain elevated about 3 to 5%. And the second part of the story is, I'm kind of a bit of tired to hear that SBI comes back every time post a result will say the worst is behind us. I don't know what is the worst and what is, better than the worst coming up. It's at the same price as we saw in 2016. The stock price has done nothing. So the fact is that the Indian banking piece is a bit barbed. The cheap are very cheap. The expensive are a little pricey, but they're getting corrected. I can't see reasons why you will pay a spectacular price to book of maybe about 1 to 1.5 for a 10% ROE business.
Sure. Krishna, we're less than 40 days away from the US election. And, history's told us that these are big events that the markets take heat from. Assuming the two probabilities, A, continuation of the regime with Trump coming back to power, or B, perhaps, which also could be a high probability of Biden coming to the chair, what could be the possible market reaction? And are we bound to see heightened volatility and perhaps weakness in US equities and thereby the rest of the world as we approach closer to the elections?
Yeah, I mean, the only way I will not be wrong is if I don't answer the question. The fact is, when last term when Trump was elected, there was absolutely consensus opinion that the market is going to crash. Trump will come in. The market actually corrected for exactly about 5 hours. The next day, it was all back in full glory. I think elections make a bit of volatility because people are speculating and conjecturing about the outcomes. But honestly, I feel that there is a lot more to it beyond politics and election. I think we attach too much importance to that. What is possibly in my mind is to kind of think about what economic policies and what the Fed might do post the election. Whoever comes in, I can't believe that the China rhetoric is going down. I can't believe that the desire to get inflation back, the desire to get full employment back is going to be anywhere away from the agenda for any of them, whoever come in. Having said that, I mean, rates are zero. You can't change that. And there is no massive impetus for the rates to move up. That's what people will look out for, irrespective of whether it's Biden or Trump. I think, we attach too much importance to their being wherever they are. But both of them will possibly kind of work on similar thoughts, though one may be a bit different from the other.
Yeah, that's exactly what I wanted to talk about, because the House of Democrats, as we understand, is now mulling a sizable relief package. And, the number being talked about is perhaps $2.4 trillion, could come in as soon as next week. Who knows whether the bill is going to be passed and how long it's going to take. But if that were to happen, Krishna, assuming, and it happens as early as next week, do you sense that it's, then going to take care at least of the near-term temperament of the market? Because eventually what markets would care about is liquidity and a stimulus right now.
No, so there is enormous. I mean, everybody is aware of that. I mean, and money is reasonably cheap, capital is available, and rates are zero. So, and people are getting money for not working as well. So, it's like as free as it gets, that is to kind of sustain the markets. And so, essentially that you don't kill the last goose, which is kind of laying eggs. The fact is that the economy, is in trouble, and everybody is aware. And you don't want to kill equity markets because that's probably one last source of capital which is available, which kind of enhances the asset value stroke. You kind of have a venue to increase the personal wealth of people. And there are multiple, it's a kind of a game which is well known to all. And you probably will not let that kind of go away. And as long as money is cheap, money is free, I think equity as an asset class will sustain, and people will kind of keep looking out for incentives. Economies will keep crumbling, but doesn't matter. I think it's a game which is going to go on for a while.
Okay. I'd like to draw your attention to what essentially is happening to the consumption part, which is discretionary or the non-discretionary. Most auto companies and consumer companies have come out and said that, look, we've gone back to pre-COVID levels. 85 to 90% of our pre-COVID demand and top line is back. Would you take that with a pinch of salt, or you think that the economy has surprised us and we should accept it and we should be happy about it?
The economy has not surprised us. We don't need to be happy about it. But the fact is, I had a few calls over the last couple of weeks, and there are some very interesting thoughts. We will know what it is in about 6 to 12 months' time, but there are 2 pointers which are important. There is a lot of pent-up demand, part one. 6 months of lockdown, people are coming out. There is a pent-up demand which is unwinding. The second part is, I think the entire COVID and other things has resulted in a bit of social distancing and mode of transport, and people are getting into the cheaper end of the motorcycle and, or let's say for other commute purposes, so which has kind of seen a fair bit of demand. Going into the festive season, I'm given to understand that there is a follow-through. It is reasonably decent. But I must kind of, I have been cautioning myself, though we've been on the contrarian side where we thought 1 year back things were negative 25%, where we thought 6 months back when it was negative 25%, we thought there was an opportunity. But we're beginning to think that the opportunity is probably waning and will wane very quickly. And there are 2 reasons for that. First is we picked up a data point which I'm not sure why it is not widely publicized, that 40,000 crores of money was withdrawn from EPFO, and about 10 million people withdrew about 40,000 crores, and the interesting part is they're all with monthly salary of less than 15,000. When you dip into your EPFO, you are clearly kind of dipping into savings and assets, which is spent for longer term. This suggests to me that there is a fair bit of unemployment, which may be hitting the MSME space, which possibly is not very well documented. The second part of the story is there is a rural impetus. Agri has been decent, so there could be a demand propelling there. But the urban story is clearly wobbling, and if we think that the urban story is more premium and the rural is more massy, the rural can possibly kind of, hold up. But I am not sure whether it has a follow through over the next 12, 24 months that it can carry the entire economy. There is a bright spot in the entire rural space, but in the discretionary space, I don't think the rural demand can by itself see through for the next 2 to 3 quarters and sustain it going out.
Great point. I'll explore the DPFO point. I remember reading it, but in a sense, I need to take it forward on other shows. And just for the benefit of our viewers, agriculture in India accounts for less than 20% of India's GDP. So even if agriculture does well, it's not that 80% of the economy is going to be coming back. Okay, Krishna, I'll again talk about or perhaps seek your views for our viewers on something which could be called as a mega trend. And the mega trend is that big companies are becoming large companies are becoming super large, and super large companies are becoming mega. It's evident in every sector, it's evident in every part of the world. If that is the trend, then what is left for stock pickers and mid and small cap investors? Because if the economy is going to morph into 10, 15, 25 companies, then you pretty much know where earnings and where everything would move.
Yeah, that's why you have the regulator who tells you that you need to buy more than 25% in small and mid caps to kind of save them. No, but jokes aside, I think it is a very challenging situation where large get larger and the large will get stronger to become larger over time. But the mid and small are the ones which will struggle a lot. And India is a country where we have a lot of mid and small, both in terms of employment and also in terms of GDP growth that comes from the space. It is ironic that the world is going through an economic divide as well, even now as the lockdown kind of persists, that the rich kind of don't get very affected, the rich get richer, and the poor get poorer because of the environment that we are in. A lockdown doesn't impact the poor. Doesn't impact the rich. In the same context, I feel that the mid and small space, they're finding it difficult to get capital. They're finding it difficult to, go out and keep their shops running. Difficult to get employment. People for employment. The F&B. You can keep counting them. So it is a difficult situation. And what is happening in US? What is happening in Taiwan, Korea, even China for that matter, and India too for that matter, is like. The entire system is getting barbelled, and it is ironic that they will have to find a way to interest moratoriums, and those things are very short-lived. They don't kind of provide the boost and impetus that is required for sustainable 3 to 6 months, 12 months, 24 months of the ability to navigate out of this troubled waters.
So what's the big trend, Krishna, which has emerged out of the last 6 months? By the way, in India, at least, from the first lockdown date, it's been 6 months already, and I guess longer where you are right now. Does it seem like IT as well as healthcare are the two places that you need to be in for the next foreseeable future?
I think, I'm not sure about healthcare as much. I think IT is clearly a space to be. There are other smaller trends which we kind of been following and tracking down. One is the awareness of the way health and health trends have been. And the lockdown has clearly kind of changed the wiring and upset the wiring of people quite significantly. That in the developing part of the world, we kind of never took insurance very seriously. And this is the time that people will kind of wake up and say that, insurance is a bigger necessity than anything else, because if there is a situation that we are in, it will be an imperative soon enough. Having said that, I think, I believe that IT will continue to be a kind of very strong player into the system over the next 12, 24 months, because that's changing the world quite a lot. The third thing is the model where I feel that there is a little bit of value in terms of people staying at home and people figuring out that they can release a lot more time and work carries on. I believe that there is a subscriber model for entertainment stroke other home-based activity which can be delivered through either broadband or otherwise. So the subscriber model will become a very interesting model for longer term. And so three parts. First is I think healthcare is exaggerated. Insurance is a better piece. I think IT, both as SaaS, software as a service, and IT as a delivery platform will become far more important, relevant, and sustainably through for the next few years or maybe longer. And the third bit is, I think, the subscriber model for delivery of either entertainment or other services into households will become extremely relevant over the next few. But that will have collateral damage. Real estate will probably see collateral damage. I guess people will realize that travel is a far overrated. Business travel is even more overrated than what it has been in the past.
Wrap up our discussion today with a simple question. You have years and years of experience of investing in equities, but if somebody asks you a simple question, which is that, give me a way how to get rich, how would you address that?
Nikunj, if I had the answer to that, I wouldn't be here in the show. I would have been quite rich by now. But but we all are in the journey where we try and get there. There are a couple of things which I've learned is you need to be away from the pack. Sometimes consensus is not necessarily right. And if there is consensus and if everybody is on the same side, there's no trade. The second part of the story is that I think you need to be careful that the horizon that we are in now or the environment that we are in, your horizons have to be a bit longer. I heard you say that you can't forecast weather. Nobody can, but everybody tries. The fact is you've got to stop doing that and think that I buy merits of a corporation and believe that earnings will flow through and businesses will kind of survive through turbulence. And, in my opinion, it's very difficult to, get money quick. But last but not the least, it's possibly not so difficult to become rich, but it's very difficult to stay rich.
Krishna, on that note, we'll let you go. Great as always for chatting, having you over and chatting with us.
Thank you. My pleasure.